I've backtested this scalping strategy thousands of times, and every single month the results stayed consistent. No indicators, no fancy setups, just pure, clean price action. By the end of this video, you'll know exactly how to trade it, step by step, and how to catch moves like this one before the crowd even realizes what's happening. In this video, you'll learn step by step how to trade the most powerful scalping strategy, even if you're a complete beginner. You'll understand market structure, you'll learn how to spot support and resistance levels the right way, you'll master the BRR pattern, a 3-step setup for high probability trades, you'll see how to use top-down analysis to align your trades with the main trend, and finally, we'll look at real chart examples so you can apply everything you learn with confidence. This scalping strategy works on the 1-minute and 5-minute chart. This strategy works on all markets: crypto, forex, stock, commodities, options, and futures. By the end, you'll know exactly how to trade this strategy from start to finish. Before we start, make sure to like this video, subscribe to the channel, and hit the notification bell so you don't miss any of the upcoming strategies. Let's get started. Now, let me show you a real setup. Simple, clean, and easy to understand. The market makes a breakout, followed by a pullback, which forms the retest, and then a clear rejection candle confirms the move. This is the BRR pattern: breakout, retest, and rejection. A setup that appears again and again in every market, every day. All you need to do is place your entry, set your stop loss, choose your target, and watch the market move in your favor. But here's the truth most traders miss. You can have the best looking setup in the world, perfect entry, tight stop loss, everything in place. Yet, if you misread the market structure, that perfect setup can collapse in seconds. That's why before anything else, we start with the foundation: market structure. To trade the BRR pattern effectively, you first need to understand market structure, the foundation of every trading decision. The market only moves in 3 ways: uptrend, downtrend, or range-bound. Recognizing which phase you're in changes everything. It's the difference between trading with smart money or against it. Let's start with the basics. In an uptrend, the market creates higher highs and higher lows. Each higher high shows that buyers are still in control, pushing price to new levels. Each higher low tells us that when sellers step in, they fail to take price lower, showing strong demand in the market. Inside every uptrend, there are 2 types of moves: the impulsive move, which is strong and fast. That's when smart money is actively pushing the market in their direction. The retracement move, which is slower and corrective. That's where most retail traders get trapped, thinking it's a reversal. In an uptrend, buyers buy low and sell high. They use retracements as opportunities to enter, not as signs of weakness. Every time price pulls back, institutions accumulate more positions before the next impulsive leg. In a downtrend, the market creates lower lows and lower highs. Every lower low shows that sellers are in control, breaking new ground. Every lower high reveals that when buyers try to push back, they can't even reach the previous high, showing weakness in demand. Again, we have impulsive and retracement phases. Impulsive moves happen when smart money dumps large positions, creating sharp sell-offs. Retracement moves are small pullbacks, the illusion of recovery, where retail traders often try to buy the dip too early. In a downtrend, sellers sell high, buy back low. Institutions use retracements to add to short positions, while most traders get trapped buying into falling markets. And finally, we have the range-bound market. This is when price creates equal highs and equal lows, moving sideways with no clear direction. It's a phase of equilibrium between buyers and sellers. For beginners, this is the most confusing phase, because the market looks unpredictable. But in reality, ranges are where smart money prepares their next big move. They accumulate positions below support and distribute above resistance, creating liquidity traps to hunt stop losses before the real breakout. Ranges exist because both sides, buyers and sellers, are waiting for confirmation. The longer the range holds, the bigger the breakout that follows. So before you take any trade, ask yourself, am I trading in an uptrend, a downtrend, or a range? Because identifying this correctly decides whether your BRR setup succeeds or fails. Now let's move to the second component of market structure: support and resistance. So what exactly are support and resistance levels? They're price zones where the market has previously reacted, either rejecting the area or reversing direction. We draw them on the chart because when price returns to these areas, they often become decision points, places where liquidity builds, traps are formed, and smart money steps in. Support and resistance are not just lines, they're zones where the market reveals who's really in control. For a support or resistance level to be valid, you need to check a few key criteria. These filters separate random lows from zones that truly matter to smart money. Major swing highs and lows. Start with the most recent extremes, the clear turning points where control flipped. These highs and lows are natural reaction zones the market remembers. Multiple price rejections. Levels that reject price more than once attract attention and liquidity. Each clean bounce without a break strengthens the zone's relevance. Clear, obvious levels. If you have to force it, skip it. Strong levels jump out on a naked chart. No guesswork, no squinting. Strong reactions away. Look for impulsive moves, large bodies, fast displacement, launching from the level. That kind of response signals real order flow, not noise. Role reversal. When a broken resistance holds a support, or vice versa, the level is validated. Trap traders around the flip often fuel the next move. Recent respect matters. Freshly respected zones carry more weight than stale history. Markets evolve. Prioritize what price has reacted to lately. You don't need all 6. The more boxes a level checks, the stronger it is as a liquidity zone. Now let's move to the heart of this scalping strategy, the BRR Pattern, which stands for Breakout, Retest, and Rejection. This setup works because it follows the natural behavior of smart money. First, the market breaks through a key level to trigger stop losses and attract traders in the wrong direction. Then, it retests that same level, testing whether it will now hold as new support or resistance. Finally, a rejection candle confirms the real direction of the move. To trade this pattern correctly, you need to follow 3 core rules. Strong momentum into the level. Look for large-bodied candles as price approaches the zone. This shows strength. The market is committing to the move. Weak momentum on the retest. The pullback should be slow and controlled. Smaller candles, lower volume, or hesitation. This shows that traders are unsure and momentum is fading. Strong rejection at the level. Finally, wait for a clear rejection, a sharp candle with a long wick or an engulfing bar showing clear control from the dominant side. When all 3 align, strong push, weak retest, and clear rejection, that's your confirmation. It's where probability is on your side and you can plan your entry, stop loss, and target with confidence. Remember, one missing element can turn a high probability setup into a trap. Patience and precision are what make the BRR pattern powerful. Now let's look at a real chart example during an uptrend. In an uptrend, price forms higher highs and higher lows. The impulsive moves, those strong bullish pushes, show when smart money is active. The retracements, those slow pullbacks, are where retail traders get trapped, thinking it's a reversal. But to professionals, those pullbacks are just opportunities to buy cheaper. On this chart, we can see price pushing higher, creating a strong impulsive move that breaks above resistance with clear momentum. Large-bodied candles, no hesitation. That's the breakout. Then, price pulls back slowly. Smaller candles, weaker momentum. That's the retest. Next, we get a rejection candle right from that same level, showing buyers are stepping back in. That's your confirmation. You place your entry above the rejection candle, your stop loss just below the retest zone, and your target at the next logical resistance or equal high. Now look at what happens. The market takes off, cleanly hitting the target, a textbook BRR pattern trade. You may look at this and think, that looks too easy, I want something more complex. But that's exactly the problem. Most traders chase complicated setups and forget that simplicity is what pays. If you want to make money in trading, stop looking for what's complicated. Look for clear markets, simple structures, and clean strategies that repeat over and over again. Now let's flip the perspective. This time, the market is in a clear downtrend, a sequence of lower lows and lower highs. Sellers are in control. Every impulsive drop shows strong selling pressure, and every slow pullback is just a pause before the next move lower. On this chart, price climbs back toward a previous support zone, which is now turned into resistance, a perfect setup for the BRR pattern. Watch closely. Price touches the zone with strong bearish momentum, giving us our breakout. Then it pulls back slowly. Smaller candles losing steam, that's the retest. A sharp rejection candle appears, long wick on top, clear proof that sellers are defending the level. That's your signal. Entry just below the rejection candle, stop loss above the resistance zone, and target at the next major low. And just like that, the market collapses beautifully, hitting the target with precision. Remember, clarity wins. When you align with the trend and wait for the market to show its hand, you don't need 10 indicators or complex analysis, just a structured plan and patience to wait for it to unfold. You can't rely only on trending markets. The truth is, the market only trends about 25% of the time. The rest of the time, it moves sideways, trapped between support and resistance. So if you only trade trends, you'll miss most of the opportunities. That's why the second market type you must learn to trade is the range-bound market. In this example, price keeps bouncing between equal highs and equal lows. Neither buyers nor sellers are in full control. This is what we call equilibrium or balance. But here's what most traders don't see. This is also where smart money prepares their next big move. Let's break down how the BRR pattern works inside a range. The first thing you'll often see is a liquidity sweep. Price briefly breaks above resistance or below support, hunting stop losses and triggering breakout traders in the wrong direction. Then comes the strong displacement, a fast move back inside the range showing the trap has been set, followed by a breakout out of the range as the real move begins. Next, the market slows down, weak momentum on the retest giving you time to prepare for what's next. Finally, a strong rejection forms, a decisive candle confirming the real direction. Entry comes right after that rejection, with your stop loss below the candlestick signal, and your target is the next key level. Look at what happens. The market moves cleanly from one side to the other, taking trap traders out along the way. That's the beauty of the BRR pattern inside a range. You're not chasing the breakout, you're trading the trap behind it. Let's look at a real example of the BRR pattern inside a range-bound market. Price moves sideways for a while, creating equal highs and equal lows, a clear sign that buyers and sellers are in balance. This is market equilibrium, and it's where smart money quietly builds positions. Notice what happens next. Price sweeps below the support level, taking out liquidity, all the stop losses from traders who went long too early. This is the liquidity sweep, the moment where retail traders panic sell while professionals quietly enter in the opposite direction. Immediately after the sweep, we get a strong displacement, a fast, impulsive move upward that drives price back into the range. That's your first sign that smart money just flipped the market. Next comes the retest. Price slowly pulls back toward the broken level, showing weak momentum and hesitation. Then, the market prints a strong rejection candle, long wick at the bottom, clear evidence of buying pressure. That's your entry signal. You enter right after the rejection candle formation, place your stop loss just below the rejection candle, and target the next resistance level. So watch what happens next. Price accelerates upward, breaks above the resistance zone with strong momentum, and the range finally turns into a new uptrend. One liquidity sweep, one rejection, and one clear move. Simple but powerful. Now, let's look at the same concept but from the opposite side. The market is moving sideways, forming a range with equal highs and equal lows. It looks calm, balanced. But behind the scenes, liquidity is building on both sides. Then it happens. Price breaks above resistance, convincing traders that a bullish breakout has begun. Excitement floods in, breakout buys trigger, and stop losses from early sellers are cleared. But that's not real buying pressure. It's a liquidity sweep. Smart money uses that spike to fill their sell orders at premium prices. Moments later, a strong displacement kicks in, a sharp, impulsive move straight back inside the range. That's the first sign the trap was successful. Price then drifts back toward the broken zone, and then comes the punch. A strong bearish rejection candle prints right at that same resistance, showing that sellers are back in full control. That's your confirmation. You place your entry at the rejection candle, your stop loss just above the rejection candle, and your target at the next support level. Watch how price reacts. It slides cleanly back down, hitting the target with precision and breaking the range completely. Everything you've learned so far is powerful, but incomplete. If you don't do this before pressing buy or sell, you'll eventually blow your account. It's called multi-timeframe analysis. The rule is simple. If you trade the 1-minute chart, identify the trend on the 15-minute. If you trade the 5-minute, confirm the direction on the 30-minute. Let's see how it works with a real example. On the 1-minute Solana chart, price is clearly trending down, printing lower highs and lower lows. Sellers are in control, and every small bounce is quickly met with a strong bearish push. Then, the market breaks below a short-term support level with strong momentum. Large bearish candles, clean displacement, no hesitation. That's our breakout. A few minutes later, price pulls back slowly toward that same level. Smaller candles, weak momentum. That's the retest. Then, a sharp rejection candle forms right at the zone, showing that sellers are stepping back in and defending the level. That's our confirmation. But before taking the trade, we switch to the 15-minute time frame, and what do we see? The 15-minute chart also shows a clear downtrend, consistent lower highs and lower lows. The market may be hesitating at the moment, but the overall trend remains bearish, which supports our trade idea on the 1-minute time frame. Now, let's switch back to the 1-minute time frame to take the trade. We place our entry below the rejection candle's close, set our stop loss just above the zone, and target the next major support level below. Simple, precise, and perfectly in sync with the market's flow. And look at what happened next. The market moved exactly as expected and hit the target beautifully. Always remember, the higher time frame sets the direction. The lower time frame gives you precision. Combine both, and you turn ordinary setups into high-probability trades. Now, let's look at another chart, this time on the British pound and Japanese yen. On the 1-minute time frame, everything looks perfect. The market breaks below support with strong momentum. We get a clean pullback, a slow retest, and then a sharp rejection candle. It's a textbook BRR setup for a short trade. Everything lines up, except for one thing. Before entering, we switched to the 15-minute chart and immediately noticed the problem. The market structure isn't clear, but look closely. We have a first demand zone here and another one just below. As you can see, once price touches this demand zone, it reacts strongly to the upside and is likely to keep pushing higher until it reaches the next resistance level. That means this short trade is going against the higher time frame flow. Okay, back to the 1-minute chart. Now you know that even if the setup looks attractive, the odds are stacked against you. Let's just simulate the trade. Entry at the close of the rejection candle, stop loss just above the zone, and target at the next support level. Look at what happened next. The market went straight against the trade. And now you know exactly why, because we were trading against the higher time frame. Remember this rule: a lower time frame BRR setup against the higher time frame trend is like swimming against the current. You might move a little, but eventually the market will pull you under. Your goal as a trader isn't to be right, it's to be aligned. When structure and momentum agree across time frames, your probability skyrockets. When they don't, you're just guessing. Now, let me show you a magical tool you can use together with this strategy to increase your chances of success. It's called the Fibonacci retracement. We only focus on two key levels, the 50% and 61.8% retracements. These are the areas where smart money often steps into reload positions, buying during uptrends and selling during downtrends. To use it, open your chart on TradingView, select the Fibonacci retracement tool from the left toolbar, then click and drag from the start of the impulsive move to the end of it. If price pulls back and aligns with the 50% or 61.8% level, especially when it lines up with your BRR setup or a key support or resistance zone, that's strong confluence. These levels act like magnets for liquidity. They're where institutions scale in and where smart traders look for the next impulsive leg to begin. Let's put everything together on a real chart. This is the US dollar, Swiss franc on the 1-minute time frame. The market is in a clear uptrend. Buyers are in full control. Here we can see a strong impulsive move breaking through a key resistance level. The candles are large and solid, showing clear bullish momentum. Then price begins to pull back slowly, smaller candles, weak momentum, returning to retest the same level it just broke through. This is our BRR setup: breakout, retest, rejection. As price touches the level again, a clean rejection candle forms, a long lower wick and a strong close back above the zone. That's our confirmation. Before taking the trade, we switch to the 15-minute time frame and everything aligns perfectly. The 15-minute chart shows a strong bullish structure. Price pushed up, retraced and got rejected, a clear sign of continuation to the upside which supports our setup on the 1-minute chart. Context confirmed, the setup is valid. Now let's go back to the 1-minute chart. Now, let's add one more layer of confluence using the Fibonacci retracement. On TradingView, select the Fibonacci retracement tool and draw it from the start of the impulsive move to the top of it. Look closely, the rejection candle we just saw lines up almost perfectly with a 61.8% retracement level. That means this retest isn't random, it's where institutions are re-entering the trend. The setup now has structure, momentum, multi-timeframe alignment, and Fibonacci confluence, 4 layers of confirmation. Here's how we trade it. Entry, just above the rejection candle. Stop loss, a few pips below the retest zone. Target, the next resistance or previous swing high. Now watch what happens next. Price takes off with strong momentum, breaks the previous high, and delivers a clean, confident win. That's how professional traders build confluence, not by guessing, but by stacking logic, structure, and confirmation together. You've just learned the best scalping strategy. Simple, powerful, and built on pure price action. If this video helped you, give it a thumbs up, subscribe, and hit the notification bell so you don't miss the next one. Thank you for watching. I'll see you in the next video.